The following is a great interview with Rod Dubitsky, who's on the Mount Rushmore of nice guys in markets who say sometimes scary things. We follow his entire career journey from 1987 to the savings and loans crisis to predicting the global financial crisis, working with Paulson and Lipman, being a sell side analyst at Credit Suisse, and his experience at Moody's, Bank of America, and ultimately to today, where he is my partner in crime in talking about what is happening in insurance. I encourage you to listen to the whole thing, and I encourage you to listen to it right before bed and share with people who need to sleep well. Enjoy. Welcome to the first episode of the Mispriced Assets podcast. I have an excellent guest, Rod Dubitsky, who has been the sane man in the room for every financial innovation and at least three bubbles, starting with the savings and loans crisis, going into the global financial crisis, and the post-GFC era, where we lead to today, and the work that we've been working on together from different viewpoints, but on the same critical sectors of private credit and insurance. Welcome, Rod.
Hey, thanks for having me. I appreciate being your first guest on your podcast. Thanks, Nick.
Yeah. Who knows how many more there will be, because I will have a hard time topping this one. So I wanted to break your career that I know well into three chapters, as I did in the intro. The first one is the beginning of your career. You started in 1987, and 3 weeks before the crash in October.
Yeah, I was in a rotation program at Bank of Boston, my first job out of business school. And I joined the mortgage-backed securities desk after doing a rotation in swap documentation. And the first day on the desk, and the mortgage desk had literally just started that day. The guy who started it had me join him because I had some mortgage background. And that day was the Black Monday, October 19th, 1987. So, coming out of business school, that was a shock, a stark reminder that the markets aren't efficient and capital markets don't always work as well as one would hope.
And then quickly you moved to a government bank that was monitoring the mortgages.
Yeah, I left Boston after about a year and a half. I decided the warm climate of LA was more to my liking, and I drove cross country without a job. And after spending the daytime betting on the horses and acting at night, as one does in LA, I decided I should get a proper job. And the first job I got was at the Federal Home Loan Bank, which had the responsibility for resolving and regulating savings and loans. And it was right in the middle of the savings and loan crisis. So it was a perfect job coming out of business school to really learn how the sausage is made in terms of resolving financial institutions who are on the cusp of failure.
So can you describe for our viewers that might not have lived it, what the savings and loan crisis was, what it came from, and how it resulted?
Yeah, I'll keep it to the condensed version because there's I think before we started we were talking a little about the history of interest rates, and regulation of savings and loans goes back to the late 70s and early 80s. But really, the proximate cause was a dramatic deregulation of savings and loans. In other words, granting many licenses and then deregulating what they could do. Normally, savings and loans are mortgage lenders. That was their bread and butter. That was the majority or overwhelming majority of their assets. And under Reagan, they deregulated savings and loan, basically allowed them to do whatever they wanted for the most part. And at the same time, they said, well, we're deregulating savings and loans, so that means we don't need regulators, we don't need examiners. And of course, the opposite of true. The more you allow them to do, the more you need examiner expertise to oversee this new authority. So it was the proximate cause was deregulation of what savings and loans were permitted to do. But the history, there are a lot of other leading causes going into that.
So very laissez-faire. Can you talk about what these balance sheets were? They residential mortgages?
They started out that way, and then a couple of examples I like to give is one of the largest lenders, I think, in San Diego, and California was the epicenter of some of the largest savings and loans that were having trouble. One of the largest lenders in San Diego, one of their biggest problem loans was literally to a Yugo dealership. And for those who don't remember the Yugo, it was the cutting edge of Serbo-Croatian technology. It was an affordable car born around the same time as the Hyundai. But literally, this is the type of loans were doing. They had no idea what they were doing. This particular network of Yugo dealers, it was massive fraud. There were cattle farms that they were lending to, exploration and development, a lot of construction projects. So, going from bread and butter residential mortgage lending to this massively complex array of activities, obviously and the lack of examination oversight or regulatory oversight. And one other large component of it was junk bonds. They were especially some of the largest savings and loans were gorging on Drexel's junk bonds during the heyday of Michael Milken and the leveraged buyout, and so some of the savings and loans were heavily exposed to the junk bond crisis. And just in terms of one interesting anecdote in terms of regulatory intervention, what the regulators did, which seemed like the right decision, but it had very serious effects. They basically said, no more investing in junk bonds for savings and loan, like zero. And all junk bonds had to be sold within 5 years or they would be completely written off from a capital perspective. So what that did is you took one of the largest buyers of demand for junk bonds, you put them, you took that demand to zero and you put them in the sell category. And that's the problem with when you let these bubbles grow so large, the mere intervention and trying to prevent it from going further can actually be the tripwire that causes to unwind. And that regulatory response was in part what led to the junk bond market sell-off, which exacerbated or accelerated the losses, not only in savings and loans, but in some insurance companies.
Sounds a lot like tricolor and the private credit issues of
Yeah,
today.
it's resonates. Yeah.
So those balance sheets, do you remember how much they were levered?
Well, they had normal capital requirements. So I think going back a long time, I think they were about 4 or 5% required core capital requirements. But it depended on the type of assets. One of the big problems, again, in what they did was in resolving these savings and loans, they allow private companies, predecessors to private equity, to buy up a bunch of savings and loans. And because the private equities didn't want to put money in, they gave them this phantom equity. They said, well, we'll allow you to count 4 or 5%. We'll give you this phantom certificate. It wasn't worth anything, but they'd allowed these savings and loans to report healthy capital when that was just that was basically fake capital. They then later made another rule and they basically said, that fake capital we gave you a few years ago, well, that's now worth zero. Your capital now, instead of being 6%, is 1%. And that happened to the savings and loan I worked for after going for the home loan bank. They basically had all of that phantom capital regulated away. So the regulators initially allowed it to get the savings and loans sold. Then they said, that's a bad idea. Let's remove all that phantom capital. So like my savings and loan went from well capitalized to critically uncapitalized. Critically undercapitalized means you are at risk of being taken over. You have to put a resolution plan into the regulators. You're closely monitored and you're at risk of any day the regulators coming in and turning the lights off.
Sounds like the letters of credit on these insurance balance sheets today.
Yeah, you could have, and things like equity ABS, which I've written about. If the NAIC says that equity ABS investment grade debt is really equity and the capital goes from 1% to 30%, right, that could cause enormous strain across the insurance industry. So if you think about these anecdotes from the savings and loan crisis, a reasonable response to it can actually actually accelerate or exacerbate the downward cycle. That's why early intervention is important, which we're well beyond that now. Early intervention is about 5 or 10 years too late now.
So there's no real soft landing when you have a bubble. The savings and loans crisis to me is a lesser version of what happened in Japan a decade earlier. It's kind of rolling. There's a lot of capital destroyed.
Yeah, just like post-financial crisis, within a few years, you went from thinking I'm not going to get cash out of an ATM to the market started rallying again. The Fed eased, and I worked at PIMCO after at the end of that cycle, working with governments around the world, helping them resolve the financial crisis. So the government interventions eventually worked to keep the crisis from getting far worse than it was. There were a couple of key interventions that they had done in the financial crisis that had they not done them, there may have been no intervention that would have worked. And I'm speaking about the guarantee of the money market funds and the bank cash deposits over the uninsured limit. So the government came and basically guaranteed all cash, private, individual, and business, and that kept a mass run on the banks from happening.
Before we move on to chapter 2, can we talk about the scale of the savings and loans crisis and private credit today?
The total losses of, if I recall, is the total losses to the system was about 200 billion in savings and loans. So, and they were an important part of the U.S. economy, but not like commercial banks today, and not like insurance companies today. So I consider private credit the instrument, and then the vehicle is who's holding the bag. As Bill Ackman asked during the financial crisis, who's holding the bag? And who's holding the bag of private credit? It's pension funds, it's insurance companies, it's individual investors. And so the scale of just private credit alone at a minimum is 1.5 trillion. And depending on what products you include, it goes up from there. Once you add in private credit, which to me is part of that same ecosystem, the numbers approach 5 trillion and 10 trillion on a global basis. So we're talking orders of magnitude larger than the savings and loan. And the financial crisis, because of the amount of commercial banks it impacted, was also far larger than the savings and loan crisis.
The middle.
Now we're talking, the financial crisis. Would Citibank survive? Would Goldman survive? Would Morgan Stanley survive? I think other than maybe JP Morgan, there was doubt about every financial institution surviving. So that in and of itself was orders of magnitude. And now we're, I can't say the banks are safe, but I think the risk I'm thinking of is more on other parts of the ecosystem than the banks themselves. But they have big exposure to the.
So let's talk about last time, your experience watching. There's also, during the Clinton administration, there's legislature that allowed subprime to blossom and eventually become a massive bubble. Let's talk about chapter 2, your experiences before and during the global financial crisis.
Yeah, I'm going to take you to my next job after having worked for the savings and loan, and then I managed Bank of America's mortgage portfolio on the West Coast, and then I moved to New York in the late 90s and got a job at Moody's in their mortgage-backed securities department, rating subprime securities as well as the predecessor product to ABS CDOs. And I was there 3.5 years, and I wanted to go to work for a rating agency because they're such a critical part of the global financial plumbing that as an investor, I don't get to see a fraction of what the rating agency, the deal documents, you get to have opinion, the data you see. And I said, I need to have that inside perspective to be, whether I went on to be an analyst or a portfolio manager. So working at Moody's, I not only rated mortgage-backed securities, including the predecessor to subprime, but I also rated a product called resecuritizations. And those where a Wall Street trading desk will take 100 bonds, single B rated, and they'll say, can you put these in a structure? And Moody's, can you give me a higher rating? Can you give me a single rating? And we would take those 100 bonds, single B rated, and we would say, maybe you can get, 70% double B, 30% subordination, maybe a little bit triple B if they're diversified, right? One of those deals I did with on the other side of that trade was Greg Lippman. I had informal lead responsibility, and Greg Lippman was running a trading desk. I think it was Prudential at the time. And he wanted to do one of the largest resecuritizations. He was cleaning up his trading desk of junk. And he went to one of our analysts, and our analysts gave him indicative feedback. This is what happens at rating agencies. You don't give them final numbers. You give them an indication of what your rating might be. They then showed me, my analyst. I said, that's way too generous. So they told Greg Lippman, this was the guy from The Big Short, the fictional character Jared Vennett in The Big Short, the Deutsche Bank trader. This was well before his fame. And they said, Rod, Greg is really mad. He needs those levels. Can you get on the phone? And I remember Greg saying, and this is the kind of pressure you get at rating agencies. He's like, Rod, I could lose my job if you don't give me the levels your analysts indicate. I said, I'm sorry, Greg. That's the levels we have given you now are the right levels. And we can't, in the end, we got the deal. He didn't get fired. We stuck to our levels. But shortly thereafter, and the point of this story is that I started seeing similar deals, but being rated on a completely different desk. Instead of giving double B ratings, they gave AAA ratings. And instead of getting paid 20 grand, Moody's got paid 100 grand. Instead of being rated by mortgage analysts or mortgage experts, they were a bunch of PhD quants. And this was the ABS CDO born while I was at Moody's. And I'm like, this is insane. This is how do you get 80%, 70, 80% AAA assets from these single B, double B, triple B bonds. And then it was shortly thereafter that I went on to work for Credit Suisse, head of their subprime. But seeing the pressure starting at Moody's from a competitive standpoint, seeing the birth of the ABS CDO, seeing what was happening in subprime, those were early precursors, right? People think, well, it's 2006 and 7. I saw the seeds being sowed like 99 and 2000. That's why when people say, oh, ABS CDOs, they haven't taken losses. I'm like, it can take years for a bubble to pop. The absence of loss is not the absence of risk. And so my time at Credit Suisse was most Wall Street analysts basically put out buy and sell ratings, relative value. What are the bankers? What are the new issues coming off the trading desk? And I focused differently. I wanted to build the best data and analytics system on Wall Street. So really focused on building data and analytics, building unique databases and building models. And I got recognized for that. Our team was number one ranked after being there a couple of years. I think people appreciated, and that's critical going into the financial crisis, not just being beholden to the trading desk or the bankers, and being able to be an independent analyst looking at the actual data allowed me to be a lot more independent and to warn more than I think some of my, and that's not on me. That's Credit Suisse really allowing the freedom of an analyst to say what they want. That I don't think would have happened if I almost went to Lehman. I almost went to Bear. I mean, they made me offers. I didn't go, but I saw Credit Suisse as being unique. So as I see this bubble building, I'm putting out stories on silent seconds, no income, no asset loans.
Ninja.
I'm looking at the growth. What's that?
The ninja loans that are popular.
Yeah, I think that ninja thing, the no job, I think that happened, but that wasn't no income, no asset was a formal part of the underwriting. No income, no job. That was a bit of a fiction, but actually did happen. But yeah, that's the ninja loans. No income, no job, no assets.
A little bit of Liberty by Michael Lewis. I just want to fill people in if they're uninitiated. Asset-backed securities, or ABS. CDOs are collateralized debt obligations. So the stories, I imagine, you can verify or not, that are being told is you have these individual mortgages. When it's asset-backed, these guys are saying it's hard assets. So you know what's there. You can touch it. And then when they put it into a package, there might be 400 different mortgages inside of a CDO. They say that, sure, these are risky if you look at them one at a time. But if you look at the whole, here is our math, our assumptions, and look, these never go default in excess of 5% or 3% or whatever they say. So this is a safe package, even though each individual line item in there would be risky if you looked at it itself. So then the rating agencies will go and say, yeah, you're right. Or potentially they're saying that after being told that, and it's kind of a group think is the way that I would describe it. Does that sound about right, Rod?
No, that's exactly right. In fact, I'll pull one word out of what you had said, math. And that's exactly, they came up with these mathematical models if you have a bunch of triple B subprime bonds, the only way you can get 70% of them to be AAA is making assumptions about how correlated those individual mortgage-backed bonds, i.e. they're not going to default together. And And then you have to put that correlation assumption into some sort of model. Moody's used something called binomial expansion. S&P and Fitch use some variation of a Gaussian cupola, which is actually, as a mathematical formula goes, gained some fame for contributing to the crisis. It basically allowed the rating agencies to say, to your earlier point, oh, these are not going to default altogether. These are well-diversified portfolio. And you can look at it on its face that it was absurd, right? 100 triple B subprime bonds do not have any more diversity than an individual subprime bond. You should not be able to get 70% AAA rated, which is risk-free, right? AAA rating means risk-free, better rating than the government. It's comparable. It should be comparable. You should not be able to get 70% risk-free bonds from 100% triple B bonds, which are barely investment grade. And that was the ABS CDO. And you could see the portfolio managers gaming the system. They would take this sort of subprime bond and this sort of subprime bond, and they'd say, oh, that's subprime. This is home equity. Those are two different bonds. And therefore, we got even better correlation assumptions. Well, if you look at it, like, it's the same thing. But the rating agency's model said, well, we'll treat home equity mortgage-backed securities different from subprime mortgage-backed securities, and we'll give you better diversity assumptions and more AAA. And eventually, it was so obvious, the rating agencies should have known. They stopped that game. But for a long time, AAAs were being gained by this obvious manipulation by the CLO managers of CDO managers, simply classifying different mortgage securities under different industry standards.
And we both know that they've only gotten better at gaming and engineering.
And the models today on CLOs are the same models, right? Obviously adapted for junk loans versus mortgage-backed securities, but it's the same basic model structure that you've seen in the same flawed analysis.
It's literally the same exact thing. And we're obviously leading there, but I just want to describe it, right? So you have these borrowers that typically could not afford a home. So they're higher risk, and they might be in Virginia, they might be in Ohio, they might be in New York, California, Florida. And they're saying that they're not correlated, but the lower middle income that is buying these homes during an economic downturn are very likely to default at the same time. So that assumption of correlation was the crux of the issue, right? And for a CDO, they will sell the bottom slice. So the top slice gets hit first and they take losses first. There's 30% before it gets to better than a US Treasury. So there's not that much of a buffer on these correlated, we all know they're correlated now, borrowers that buy homes. It's all correlated to home prices and also the income of this cohort of individuals. And just because there's a little bit of a buffer, they say that, oh, this is super, super safe. That is,
yeah, exactly.
That is the essence of what happened in the global financial crisis. Can you talk about getting closer and what it feels like and ringing the bell and being in the house of Bank of America and Credit Suisse and Moody's, and you're being patient, but you're telling the story, you're continuing to do work. Your first impression is this is crazy. And then you continue to do work and go down the path of being like, I need to at least monitor this, but also try to explain this to people in the age of not having social media. What is that like? Who did you talk to? And ultimately, what did it, most interesting to me is what does it feel like?
Yeah. Well, I think there was, around the same time that the Big Short story was developing, I think all Wall Street trading desks were to varying degrees thinking about how will this end? And the fact that, I was going into the same people that Greg Lippman on the Jared Vennet in the movie was pitching his Big Short trade. We were talking to the same people, and inevitably they would say, "Hey, Greg Lippman was here. Are you guys pitching the same?" And at Credit Suisse, they actually did pretty well. They were not one of the ones who I'm not sure they even needed rescue capital. they positioned pretty well. They were big into mortgage backs and CDOs, but they pulled back quickly. They didn't pitch the big short as Deutsche Bank had done, and I think Goldman had done. But I started talking more and more to hedge funds that weren't normally interested in mortgage-backed securities. As this, around 2004, 5, 6, more and more of my clients were people who were starting to, one, either concerned about the macro economy and the impact of subprime, but also interested in shorting the market. And so John Paulson, who was the big short, even though he wasn't in the movie, was probably one of my biggest clients as this was all unfolding. And I don't remember the detail of all of the conversations, but I know he was serious enough about it to build his own. He went out and bought loan level mortgage data, loan by loan data. He bought that data. He hired mortgage loan data experts, and he set up a fund specific to shorting, which was key, because if you put some shorts in a regular fund, your long fund can overwhelm the short. So he set up a fund solely dedicated to shorting mortgage-backed securities market. And I could tell you, a story about some of the trades he was doing, which he didn't get into trouble for, but was a bit, nobody talks about it much. But they were basically, you had the hedge funds who were shorting, right? And then you had the ABS CDOs still happening, right? So as the shorts were being put on, ABS CDOs were still happening. And whoever buys the equity in an ABS CDO gets to decide what goes in it, right? Well, guess what? Some of these shorts, they were short the market, but they were also buying equity in ABS CDOs. Why were they doing that? Because they could pick the worst bonds to go into the ABS CDOs to help their short. So you buy a little bit of equity in this ABCDO and you're short massively on the other side, and you get to decide the assets. Ultimately, I'm not going to name names, but there were a few hedge funds who were doing that trade successfully, and there was an investigation. I think there was deemed to be nothing illegal about it, but it was clearly, part of that was going on. And as portrayed in the movie, as the performance started to deteriorate, I got a call from Paulson, wondering why the bonds weren't moving. He was, and this is exactly the scene portrayed in the movie as I experienced. Paulson's like, Rod, why are we seeing delinquencies going through the roof? Home prices hadn't fallen, but they're stalling. What is going on with the prices? And I said, just, you got to be patient. But, there's a small number of firms who control the pricing, the Wall Street firms. They're protecting their positions. But, at the end of the day, the performance of the loans are going to materialize. And what had been happening years leading into that, there were lots of delinquencies happening in the mortgage pools, 2002, 3, 4, 5. And we had seen through our data that so many of them were exiting the pool without a loss. So what was happening as home prices were going up and the mortgage machine was going, if you became delinquent on a subprime loan, what did you do? You sold your home because you had equity, or you went from being a B borrower to a D borrower when you got another loan to refinance you out. So I saw these large number of defaults disappearing from the pool. So it looked like the deals were doing well, losses were small. And I said, as soon as home prices start to plateau, and if you look at home price to income ratio at the time, it was just off the charts high. Like, it was obvious that home prices were on average way disconnected. And I use that as one of my key metrics to say, this has got to come down to earth. And once it did, and people didn't have the exit of refinancing or selling their home, all of those defaults started hitting at the same time. But as I was saying, the price of the bonds, the short that Paulson was short and others were short, they didn't move initially. They were just sticking there. And again, part of it was the rating agencies hadn't taken rating action. So you still had the ratings. And I could talk about why I think I may have precipitated rating actions that hadn't been happening, that had been long overdue. And it's also a critical point on how these things may unwind.
So no, that's perfect. I know exactly the story you're about to tell. Just to fill it in again, what the CDO equity is the first loss. Then after that, there might be a double B for a very small sliver, and then quickly it goes to investment grade, at least today. So the CLO equity is the residual. If everyone pays, they make a lot of money. If some people don't pay, that comes out of what they're supposed to get. But what these hedge funds are doing are not only trying to buy themselves time, but they apparently, I didn't know this, can pick the loans because they're short the double B, triple B, alt A, and even in some cases, triple A. So they're like, well, there's only 30% of buffer to triple A. So if we get to pick the bonds and we pick 10% of them and they're 80%, they're 50-50 if they're going to default in the next year, just based on our math, then it helps the other side of our trade, which is extremely asymmetric in that you're paying basis points or tiny slivers of a percent, and you're able to return multiples of that.
And by the way, that story I told you that happened then, a more recent story happened, which I don't know if you're aware of, but Carl Icahn was trying to do the same in the commercial mortgage-backed securities market. He was buying equity in a commercial mortgage-backed securities deal. At the same time, he was short a commercial mortgage-backed securities index, much like that happened during the financial crisis. This was only a few years ago. He kind of got burned because the process was manipulated, but that was a super interesting, and the lawsuit's out there, so you can see details. But you think that happened years ago, but stuff like that is still happening behind the scenes. We only got to see the Icahn trade because there was a lawsuit involved with it, but there's probably a lot of that going on now.
There's a lot of that. And all of this leads to today. We'll talk about where the CLO equity goes, but I really want to know about what it was like being at a rating aid or trying to precipitate the rating agencies having action, and your conversation with AIG, which I can't let you leave without talking.
Yeah. Well, I'll start with the AIG one because that's the one that happened in sequence. So around the time The Big Short was in its early days, AIG was AIG basically was guaranteeing a lot of these ABS CDOs. They were insuring a large part of the senior ABS CDOs, and they started getting nervous about their position. They dominated the market, and so I had a meeting with them. And I remember it well because before I was going into it, the trader who knew the guys said, "Hey Rod, these guys are the market for ABS CDOs. Don't scare them too much." They knew I wouldn't listen to that, and the fact that they let me meet AIG alone, and I walked through my standard presentation. I don't remember the details, but I remember talking to them about the correlation issue. And they said, yeah, these things seem a lot more correlated than we anticipated. And I think they were looking at exiting, but they got out of a large part of they exited the market basically shortly thereafter. And then you think the market's going to collapse because the number one insurer is taken out of ABS CDOs, but no, MBIA comes in and AMBAC comes in to fill their shoes. So the bubble continues for another couple of years, right? And that's how bubbles continue. As long as there's somebody to fill in the capital, whether it's an insurance company on private credit or a pension fund or wealth management to buy these assets that can't get sold to institutions. I don't want to use the term greater fool because it's not exactly what it is, but that's how bubbles continue far longer than they should. So when an MBIA and AMBAC came in, that kept the market going. And MBIA famously was the short for Bill Ackman was famously, and that was a big win for him. And I could talk about my involvement in that in a little bit. But as we were looking at, and because we had great mortgage models, and I knew how the rating agencies rated the bonds because I was at Moody's, we built these for one of our research pieces. I said I want to run all the mortgage-backed securities through. Focused on the triple B because they were still not downgraded, and I want to look at what we think the rating should be based on just our projected losses and looking at rating agency methodology. And I put up a chart and I said, this is what's been downgraded, 1%. This is what should be downgraded, 80%. So imagine a bar chart. 80% should have been downgraded, 1% was. So they'd taken no action. And then Bloomberg picked up the story a few days later. And I remember my quote in there, and I said there's going to be massive, massive downgrades. And once you elevate the visibility of the critique of the rating agencies that much, I don't know whether my article or Bloomberg's coverage of it precipitated, but within a few days of my article and the Bloomberg article, S&P came out with a midnight massacre. They basically downgraded, I think, 500 different mortgage-backed securities. When I covered that story, I called it a day of reckoning. I said, this could be one of the key threads that unwinds the whole thing, and then Moody's follows suit shortly thereafter, and Credit Suisse let me publish whatever I wanted to for the most part. I got into trouble for some things, but I was right in even those cases. But when you're when you're an analyst and you're saying 80% of the market should be downgraded, that's not an easy thing to go out and do. But I had enough freedom and independence and the data to back it up. Right, I wasn't just guessing. We had models, and I knew how the rating agency worked, so they couldn't hide behind, oh, he doesn't know what he's talking about, or he's guessing, or no. I had bond by bond analysis that showed that the ratings were inflated. And when we talk about my recent independent research, I've done similar things with commercial mortgage backs. But that was 2007, and then it pretty quickly unraveled from there. And I think 2007 was the last big mortgage-backed securities subprime vintage, and it went very quickly downhill. And then I started working on a lot of policy articles. Credit Suisse didn't often like that because a lot of our clients didn't like me writing about policy, especially some of the things I was recommending. But whenever Credit Suisse would say, "Do you have to write about policy?" I would say, "Well, that is the market. We're in a full-blown crisis. Policy is the market. You can't get around it, whether it's principal forgiveness, whether it's loan modification plans." And so I started interacting with another Paulson, not Hank Paulson directly, the Treasury Secretary, but one of his key lieutenants, Neil Kashkari, who later went on to run the TARP, which was the bank bailout plan. And he, very respectful guy, and I was trying to convince him to do a large-scale mortgage principal forgiveness plan. And TARP was initially meant to do something like that. That's the Treasury Asset Recovery Plan, something like that. And that was going to be to buy mortgage-backed securities and potentially do principal forgiveness or more aggressive modifications than the private sector could do. And my principal forgiveness idea was backed by data. I did analysis on principal forgiveness and that the loans did default far lower. And I published an article around that time calling for about 10 million foreclosures. And that was pretty early. And people said, "Oh, yeah, the government's never going to allow that. You're never going to see 10 million foreclosures." And that was and I just did it looking at the data and the analysis and rolling the actual behavior forward and overlaying home price declines, which I anticipated. So what they ended up doing with TARP was bailing out the banks. So the banks got bailed out.
Against your advice.
And the subprime. Yeah, I think in retrospect, given the urgency and the timing of it, I think the initial plan they were going to do to buy mortgage securities, that would have been a much longer lead time. But sitting around with the 8 largest banks and said, "You're going to accept the $700 billion, whether you need it or not," provided a firewall or psychological fire break that allowed people to think, well, the government's going to do what they can. The banks have the capital now. So I can't say it was the wrong decision in retrospect, because you have to say it kind of worked, and a few of the other things they were doing. If they did do the mortgage-backed securities, which wasn't just my idea, they actually, it's troubled asset restructuring plan or something like that. It wasn't bank bailout plan. If you look at the acronym, it was because they were going to buy the mortgage-backed securities, so banks got bailed out and subprime borrowers got 10 million in foreclosures.
So there was 3 things that allow this to happen. One, the government says lend to everyone, and then they start lending to everyone. Then the watchmen, the regulators, the auditors, the rating agencies are allowing it. And then the last thing that allows it to end is no more greater fool. They didn't get into 401k plans, and everyone was tapped out. And ultimately, people probably realized the career risk of levering up more into this. And plenty of people still experienced the downsides of taking massive career risks. But then we got bailout.
Yeah. And I think the phrase you use, they ran out of greater fools. And when you run out of greater fools, you hit the wall on the crisis. But in terms of the regulatory response, right, one of the things nobody talks about in the financial crisis was during Bush, George W. Bush's term, the SEC dramatically deregulated capital requirements for Wall Street firms. So I don't remember the exact numbers, but they went from 10 to 1 leverage to 30, 40 to 1 leverage. And they were doing a lot of off-balance sheet vehicles, which was adding to the leverage. So that tremendous increase in leverage was part of the, we talked about deregulation during the savings and loan crisis. That was part of it. But it was also both under Clinton and under George W. Bush, aggressively pushing for the home ownership. And I think, yeah, you can push for home ownership, but if you're not monitoring how that home ownership is achieved, i.e. through widespread fraud, lending to people who shouldn't borrow, and a lot of the borrowers turn out to be not, they turn out to be part of the game. Like they were buying 7 or 8 properties knowing that, there was a scene in The Big Short where they're talking to a bunch of strippers and they said, oh, we own, what are you talking about? 2 homes. I owned 5 homes, right? And I remember sitting in a cafe in Hoboken where I was living at the time, and this woman said, oh, I'm going to buy a couple of properties using these option arms, 1 or 2% interest rate. I said, you really want to do that? Do you know how risky they are? So no, I know exactly what I'm doing. If the market tanks, the bank owns the mortgage. If home prices go up, I've got a very cheap mortgage that I can, I'm paying 1 or 2%. So they didn't care about the payment shock because they were just long real estate prices. So I think towards the end, there was just a massive increase in investor occupancy fraud. And that was underwriting due diligence just went completely, AWOL.
They would have bought the Dodgers with your money too, if they could.
What's that?
They would have bought the Dodgers if they could.
Yeah. It's funny on the, I'll tell you an anecdote of one of the, I think this is public. I don't think I'm basing internal documents. There was an email at Credit Suisse, an exchange back and forth about arguing about one particular mortgage. And the borrower was a woman who was a dancer in South Carolina. And the argument went something like, and this may have, I don't know if they did this exactly in the movie, but the argument went something like, well, she's a very good dancer. Like they didn't say what kind of dancer she was. So they were trying to argue, of course she's making 200, 300,000. Of course it's off the books. It's tips and everything. So that was the kind of, so it wasn't like waive it and we're going to ignore all underwriting. Every single loan, ninja loan, they probably had some sort of very, very fragile, minimalist justification just so they could say, okay, done. And so I'm sure if you looked at 100 files, you'd probably find 99 of them found some justification to make that ridiculous loan. But that's, seeing Credit Suisse, the head of credit underwriting, and I forgot maybe it was a mortgage broker on the other side, justifying a $300,000 salary for a dancer in South Carolina. And it's like, well, yeah, it's stated income loan. They earn off the books and dancers are entitled to home ownership, right? That's the kind of, that's the kind of nonsense that was going on then.
Can you describe how bad you thought it would be? And maybe it was bad, but in a different way. And then the reality when it hits, what it feels like. And are people telling you you're right? There's probably no Schadenfreude there, knowing you. What does that feel like?
Yeah, no, there were a whole range of Wall Street opinions, and I think in terms of if I were to align my opinion with the 8 other analysts covering subprime, I was definitely on the more bearish side. I think maybe Deutsche Bank was even more bearish than me. Why? Because they already positioned to profit from the bearishness, so their analysts could be more bearish. And I think that's part of the problem is Wall Street was seeing all the big short emerging. The analysts, the traders, they could all of a sudden be liberated from needing to be happy, talk on the market, say, we can be bearish because we can make money. Paulson's our client and Michael Burry and all these other guys, they're our client now. So we are now liberated from needing to talk up this market. And I think that shifted the ability of Wall Street to be more bearish. It was way too late. But I was looking at underlying numbers, right? Because I was collecting a lot more data than I think others were. I think maybe I saw it earlier. I won Credit Suisse's trading desk, but they I can't say they were, they knew already. So all my conversations with them, it was never like, oh my God, we didn't even think of that. They were on top of it, the traders. So to Credit Suisse's credit, may they rest in peace. I warned them a lot. But one of the big pieces of data I compiled is on the insurance companies, AMBAC and MBIA. it's public data, but it's in different data repositories, and you have to take the filing data from MBIA and AMBAC. You have to match it with in-text data, and you have to align the mortgage securities to figure out. But I was able to put together a massive database of all of the AMBAC and MBIA holdings and look at the ratings and the credit support. And just like I was able to forecast the ratings downgrades, I was able to see that MBIA and AMBAC were toast, absolute toast. Around the same time, as I was compiling this data, Bill Ackman does his thing, his who's holding the bag, MBIA. He had all this data. I'm like, wow, where the hell did he get that data? That's the same data we've been compiling. And I think one Wall Street Journal or somewhere said, oh, he got it from a Wall Street firm. So I called this trader who asked me to give him a data dump. I said, did you give Ackman our data? Which is fine. It's legal, right? And Ackman's a big client, so there's nothing wrong with it. He goes, yeah, I did. So when Ackman did his who's holding the bag, if you look at the data about it, like that came from my team. And by the way, you know who that trader was? Kareem Surigeldin. If you watch The Big Short, he's the only schmuck who went to jail. He was the trader. I worked with him on a Credit Suisse. So he was the guy giving the data Ackman, who allowed Ackman to make his big home run bet on MBIA. And another anecdote on MBIA, I remember sitting in a risk meeting. This is, I thought when all the risks were obvious. I was invited to the risk meeting, even though I don't normally go because of my role in subprime. And I said, MBIA is toast. And afterwards, the head of risk said, Rod, what the data I'm looking at says MBIA is fine. I said, you better check your data again. They're not fine at all. So even while it became obvious to me and people looking at the data at the senior levels of risk, even at Credit Suisse, who did well, there was still some faith or that MBA or AMBAC. And you can also see what happened at Citibank. They were guaranteeing some of this that was sitting off balance sheet because they were guaranteeing a AAA, and AAA requires no capital. It was an off balance sheet obligation because it was deemed risk free. But they report that as an off balance sheet. I said, this AAA Citibank is going to be entirely brought back on the balance sheet. It's going to F up their capital, increase their losses. And so I started becoming bearish on the banks in general as I started seeing the threads that I saw with MBI and AMBAC, and I followed them through. I didn't have all the data. I only had some of the more obvious ABS CDOs. I didn't know what Lehman was doing with their commercial mortgages, or they did this off-balance sheet repo in the UK. That was a big part of their failure. But I saw enough of the threads from the ABS CDO and subprime to know that the banks were also at risk.
So this is really Ackman's claim to fame. To his credit, he's really good at communicating. He's a good writer, and he's a good speaker. But a lot of this, I would be curious to hear his perspective. Maybe he'll be the next guest. When shit hits the fan, what does it feel like?
Well, it was, literally, and not, I think I moved from Credit Suisse to PIMCO shortly after, in 2009, shortly after Lehman went under. And I remember I was going to the bank every day and taking ATM money out. And Mohammed El-Arian, who I knew from a little bit from, we were at Moody at PIMCO together. He was also on the trading floor. He said, hey guys, I don't know if the banks are going to be operating if this keeps happening. So it was every bit as scary, and probably even more so from the inside, because you start following where all the losses could lead without government intervention. And it was global. It had gone global. I mean, nobody talks about it today, but the German Landesbanks, well, who the hell are they? They were one of the largest buyers of ABS CDOs. Well, what happened with them is the government removed the guarantee. These were these government guaranteed land banks, or like mortgage banks, like think of American Savings and Loan. That's the German Landesbanks. They were government lenders, guaranteed. And then the government said, well, in 2 years, the guarantee goes away. So what did these German Landesbanks do? They hit the floodgates with savings. They issued as much guaranteed debt as they could, and they had billions and billions of dollars to invest. Well, what did they invest in? A large number of them, and they almost all failed, invested in ABS CDOs and subprime and all this toxic stuff. So almost all of these German Landesbanks failed because of that. And at PIMCO, we had clients. We had the Bank of England. We had the ECB, because I worked in the advisory group who was advising governments on managing the fallout. So we talked to SOFIN, which was the German regulator, because PIMCO was managing one of the large German Landesbank bailout. So you see it going global. And you think about money not coming out of the bank ATM, it was real. It was not, and that, like when you see that as real and not paranoid, and when Muhammad El Arian is echoing your fears, like a serious guy like that saying cash may not come out of ATMs, may not just, and it was real because this one of the big problems with Lehman was not Lehman going under, as bad as it was, as most people may forget. And there's a little money market fund called Reserve Bank of America. I think they were the first money market fund, but they own not a large percent of Lehman, maybe 2%. But when Lehman went under, they broke the buck, meaning they had to mark that Lehman to zero or whatever, pennies on the dollar. That $1 money market fund went to whatever it did, and that freaked out the entire money market sector. All of a sudden, you went from Lehman failing to a global, to U.S. wide run on money market funds, and anyone who had money at banks that was above the insured deposit started pulling out, and there was just a massive sucking sound of liquidity coming out of the banking and money market industry. And that was the tripwire why getting money out of a bank was not paranoid, it was real. And the government came in, and this is one of the most important actions, is they guaranteed money market funds, they guaranteed bank deposits, even for businesses above the insurance limit. And that, like TARP, provided one of the critical fire breaks to keep it from absolutely imploding. And one other thing, and I don't normally talk about this, but you're a technical guy. One of the biggest bailouts we've done that nobody talks about is swap lines, global swap lines. I think the government lent $200 billion to ECB, Bank of England, Bank of Japan, because everyone was having trouble getting dollars during the financial crisis. Global central banks were at risk of failing. And so the Federal Reserve had to, I don't know the technical details of how it all happened, but these were legal lines. They had to open up the swap lines. But I think they tried to keep it quiet because if you imagine if the Americans were pissed off about bailing out the banks, imagine, we're bailing out
other countries,
the ECB and Bank of Japan. And so that's you have to understand how these crises play out, understanding the plumbing of what was going on during that time and how it could play out now. I think it's critical. So I think thanks for giving me the time to go through this history, but I think it's a history lesson that we may find ourselves revisiting more painfully in the current circumstance.
I think it's incredibly crucial. So the swap lines that we're seeing today with the Iran war, you can't ignore those. You're devaluing the dollar in order to help out another country or plugging their gap, when alternatively the argument is that if they go down, it's going to affect us. But we don't.
Yeah, I think we didn't have. I think it was, it's a little bit beyond my expertise, but my understanding is there was not much of a choice without making this go from a U.S. based crisis to a worldwide crisis.
Right. But then it's like taking our army and putting them in Europe, right? We're not getting.
Yeah, it's the same.
We're not getting any.
Who are we defending?
Except for potentially an ally that's stronger. And people should consider that a bailout. So what I want to talk about right now, just briefly, and then move on to today, is this started in mortgages. It was subprime, right? All of a sudden, it's spreading. The whole credit market is seizing up. Mortgages were collateral. So when you have a collateral issue, it spreads from the money onward to asset prices. Today, if we move forward, 2009, this is chapter 3 now, 2009 or 2010, Athene is co-founded by Apollo. Eventually, they buy it out. But after, in 2010, I believe Dodd-Frank was 2010.
Yeah, I think that's about right.
Okay. So Dodd-Frank was an assessment that we cannot have the banks ever again be at risk. So what they tried to do is say that we're going to declare these systematically important. That should provide some level of confidence in the banking system, as it had all been lost and Bitcoin is created and people think it's all fugazi. So Dodd-Frank was regulating the banks. We're taking them from 30 times Lehman leverage back down. And we're saying that we're going to do all these things, Basel 1, 2. And we're going to adequately assess risk. But what has happened since then, driven by the private equity backed insurers, is that they stepped in to fill the void. So all of a sudden you have a shadow banking industry. And what their model was functionally take the Berkshire model, invest the float in what they have, a business in, but not even remotely close to the business they have now, which is lending directly to private businesses, something that banks used to do. And banks used to lend to the mom and pop businesses. And they knew, especially community banks, they knew their borrowers. And all of a sudden, you've restarted the process. So instead of decreasing risk, you've just shifted it. And all of a sudden, there's super access to capital and it's private equity. It is not as easy. In fact, you can't if you're a mom and pop business. Let's say you built a $10 million EBITDA business. The only way that you have access to this private credit, direct lending, is if it's bought out in an LBO by a private equity firm. So that has grown. And can we talk about how you have experienced that? You come out of the global financial crisis. There's a global debt wall in 2010. Obama gets elected for a second term, and all of a sudden markets are just creeping upwards as the Federal Reserve never removed their emergency measures. So all of a sudden markets are behaving differently than people expect. Cost of capital is slowly creeping down. And for 10 years, the average interest rate at the end of the year from Jan 1, banking analysts, if you took the mean of the average, where are rates going to be in a year, it missed by 100 basis points, meaning consistently rates were lower than expectations for a decade.
Expected. Yeah. I think clearly in the post-COVID period, the interest rate cycle led to some of the worst performing vintages. And I first published an article in March of 2020, right during the early stage of the COVID crisis, in the Journal of Structured Finance, and I talked about iron triangle between private equity, pension funds, and CLOs. And this was early stages before the insurance companies exploded. This was early stages before private credit. So this was even pre that part of the bubble. They existed, but they exploded onto the scene. Both those factors. And I just looked at again the CLO model of today is got the same flaws as the ABS CDO, the same erroneous assumptions.
It's all over again.
And since then the performance has actually been worse, but the rating agencies aren't changing their models. If you look at, so the models were bad at inception, the ratings were bad at inception, but they're even ignoring and even manipulating the ratings now as we see some deteriorating performance. It's like, how are private credit doing so bad, but CLO is still holding up there, although CLO equity price-wise is having trouble. But, Moody's put out a piece on revising their standards on CLOs. They're easing them. They're lowering their standards on CLOs. And that happened, and this is just this last month. And Fitch, so on June 2nd, Fitch published their relaxed methodology. June 2nd, Fitch, Moody's comes out 4 days later, and they put down their own relaxed CLO criteria. And Moody's just published in April an update criteria. You don't change your criteria more than like once every couple of years. So the fact that they just published their criteria in April, 4 days after Fitch relaxed theirs, Moody's all of a sudden, we've been too harsh. There was not a single factor that was made more conservative. Every single relaxation on Fitch and Moody's, it was relaxation. You think if you're changing your model, we'll tighten this up, but we'll loosen this because we're overly harsh. No, it was purely to get market share on new issue. And I posted a comment to Moody's website, which hopefully they'll publish. I said, loan recoveries are collapsing. And I gave them a headline from Fitch. Loan recoveries that are a 10-year low. How is it that you're not updating your loan recoveries? All of these,
which is a critical assumption. It is.
It's a critical, exactly.
There's correlations, and if this goes bad, how much do you get back? If those are
Exactly.
going down, and they always do, they're inversely correlated. So when defaults go up, there's less of a buyer for these assets. If you think about, if you have two car wash companies go under, and they're both trying to either sell the business or liquidate the assets, all of a sudden there's supply of the assets and supply of the businesses. So it makes sense that they go down. And then when you look at software, if you try to sell those companies, who's the buyer? Especially if they're all coming online at the same time and there's more supply than there is demand for that type of turnaround story.
Well, I said in my comments, I said, look, you guys are commenting on the risk of software companies, right? There's a mass correlation event happening with software companies. How is it that you are not changing your correlation assumption? Correlation is not a static, unchanging, forever immutable number. It is a market dynamic. Maybe it doesn't change as much as recoveries, but it is a dynamic input to a model that should be changed. But you'll never see the assumptions. In fact, one of the assumptions Moody changed in their model, they hadn't changed it for 7 years. It was a default multiplier on top of their regular numbers. It's just like a plug figure, and they lowered it for the first time in 7 years. I'm like, I reverse engineer Moody's model. It's on my website. They use this 1.96 multiplier. And all of a sudden, the first time in 7 years, 4 days after Fitch lowers there, Moody's decides, well, we're gonna lower our default multipliers. And they give a reason for it. It's like, well, how is it that in 7 years you didn't change that one number? And all of a sudden now, 4 days after Fitch relaxes their criteria, you decide now's a good time. And I knew the exact number because it's on my website, because it's an input into their model. And that's the kind of BS. And you made a critical point that I want to touch on, that they miss from their models. The correlation of recovery and default seems obvious, right? Defaults go up, recoveries go down. The more companies that default, but in the rating agency models, they're static. The recovery is a static input into their model. And on my website, I said, well, let's make recovery dynamic. What happens to the rating? And the rating goes from AAA to BBB. Just doing the logical thing you said, making sure recoveries go down as defaults go up. And that's not in their model. And not to mention that recoveries are dropping because of covenant light loans and liability management exercises, which if you want, you can explain to your audience.
So they are selling the hard assets. Maybe you have a factory and you have machines, and all of a sudden you're having another loan so you can lever up more that has a lien on the machine. So you might have first lien to the business, but the business doesn't include the stuff that you can touch and has value. So what has happened, again, we started with the CDOs, single mortgages, and you bundle them up and there's correlation assumptions. And because you bundle them up, there's diversification and you get rated higher. This is happening with businesses. And the one thing that I keep on saying that nobody else, I haven't heard anyone say this, is try liquidating a business. Try liquidating a dental practice where you have to go through and say, okay, well, what are all of the dentists at every single one of these locations? Okay, how long is their contract? How long are they going to stay on for? Okay, how much are the tools for? How long are the tools? In 2008, you were selling homes. Sure, you would have to have an inspector go and be like, are there termites in there? That is something that's pretty, you stamp it. And then all of a sudden, someone's stepping in, okay, it's down 40% or 60%. I'm a buyer here. In this scenario, they're actually going to be harder to liquidate. And one thing that I would like to fill in is in 2008, they had either hedge funds buy the CLO equity or the banks would actually eat it. And the banks would eat it because they were making so much money on fees. And they were like, okay, well, if this doesn't blow up in a year, we're going to get our money back based on what we have on the fees as well. Today, as Rod and I have done a lot of work, the main buyer of CLO equity, which is the bundled up businesses that they say the vast majority is investment grade, that these insurers are loaded up on, are BDCs where retail investors are not told what they own. And in fact, these funds have marketed 96% first lien, but they don't count the CLO equity, which is levered 8 to 10 times and first loss.
Yeah, exactly. And ARC is the one of the biggest, and they have other ways of having what's called back leverage. So ARC has two different equity investments. One is in their Ivy Hill CLO platform. So they have this very. If you look at ARC's two largest investments, they're affiliated equity positions. One is in Ivy Hill, one is in senior SDLP or something like that. It's a senior loan fund. It's basically a mini ARC, or maybe not a mini ARC, in another fund making more loans, but it's an equity position. And the way they account leverage, they don't account the leverage in that equity position in that loan fund. They don't properly account for the equity in the CLOs that they own off balance sheet. So
So they'll say
there is that.
they'll say it's
Yeah.
1.4 times, but it's really 1.8 or 1.9. And that
Yeah,
is
exactly.
very close, given just a little bit of mark to reality, to the ratio that has been Congress has loosened. Again, we're all talking about loosening regulations. It just keeps on going. Congress has loosened it, and yet still a lot of these BDCs are close based on what the reality of these positions were, considering that CLO equity is having its worst year in at least a decade. If they had to mark those all down, a lot of these BDCs are in trouble just on that part of the CLOs themselves. They also have individual credits, which you can go through and say 60% of net assets are software. And it might not say software, it might say business services or healthcare. So once you start questioning the individual credits, it gets way worse.
Yeah, and the other aspect of these owning equity interest in CLOs and these other flotsam and jetsam, Cliffwater owns a ton of these highly leveraged complex vehicles. You have to look at the funding structure of the BDCs, right? So you've got secured debt, which is your JP Morgan, your Wells. You'll see them on. In fact, we built a whole BDC database and front end website. You can see all the banks, who the largest banks are, which bank is lending to which BDC. It's not easy to find, but we compiled the data. So that's banks doing secured revolving lines of credit to the BDCs. And you might also have CLOs that are on balance sheet, meaning that you can see the debt. And then you'll have unsecured debt, which is mostly rated BBB. But if you look at all of the pledged loans to CLOs or pledged to the banks, there isn't much less for those BBB debt. And ARC just, I don't know if you know, but I'm catching you real time on this. ARC had $1 billion note due July 15th, $1 billion. And that's the kind of thing, if they had been downgraded, which they should have been, they would have had real trouble refinancing that. And we might come to this later, but who's buying a lot of that BDC debt, right? You think, that's dumb money is buying that, right? No, $9 billion sits on Athene's balance sheet because Apollo decided it's good for Athene to buy $9 billion of BDC BBB debt, which I don't think any of that should be BBB, probably not even BB, because all the underlying loans, guess what? They don't publish it. But I know from reading the reports on the CLOs, that's single B and triple C loans at best. And all the best loans, as S&P says, if they're doing a CLO, we're taking the best loans and putting in the CLO. So guess what? When the CLOs are done with their collateral and the banks are done taking their collateral, how much is the unsecured debt going to have? And then how much is left in the equity? That's why when I see a NAV discount of 20%, 30%, I'm like, I yawn, because it could be 100% because the NAV might be zero once you properly mark the underlying loans and you look at the structure of how those loans are committed to the banks, the CLOs, and what's left for the unsecured creditors. And they get to eat before the equity does, right? If you're buying a public BDC debt, that unsecured BDC loan lender, and in this case, it's Apollo, and for $9 billion of it, they eat before you do. So you're last at the buffet table if you're an equity holder in these BDCs, because a lot of those loans have been pledged. And we compiled the data, and we're still looking at it, but it's not so easy to compile all the pledged data. But some of these BDCs have pledged 90% of their loans, and that's not going to the unsecured debt. So
what people have to understand is that if you own a BDC, you are the stepchild. You are not the favorite child. The favorite child is an insurance. And when we're talking about the CLO equity, the reason why that's so crucial is because without somebody who buys that, you can't have BBB, you can't have the A-rated sections of the CLO. Somebody has to take that. The bagholder is no longer the banks or hedge funds that are in on the game and are anting up just to fold the cards. It is now the BDCs. And what we said before is, well, there always needs to be a greater pool. So they're going towards 401ks now. What could end this? I get asked this all the time. Less inflows, a rate of change on inflows, in addition to disruption from software, and then their Texas hedging with data centers, and maybe both fail at the same time, but certainly one of them based on the capital reserves. So just to fill people in, how do we get to insurance? We talked about how private equity rushed into this, and they can manage the assets. So they can collect the fees on these massive balance sheets. And we're talking $10 trillion of balance sheets. How much do you have on in-force policies for the US life and annuity sector?
It was like 60 trillion, which is the face amount of the policy, $62 trillion.
So that's not how much money they have on their balance sheets, but that's how wealthy mostly boomers feel and their security in retirement. And they don't know that they're taking credit risk with an insurer. So these PE-backed insurers have bought these PE companies have bought these PE-backed insurers. They're investing the assets. They're collecting fees. It's great. It's free money. It's just like Berkshire did, except they're taking excess risk. And in fact, if you did a direct lending to a dental company, you would have to reserve a lot of money for that. Not as much as I think it would be. It might be 3 times leverage that you can do it at, which if you're a stock trader, retail stock trader, if you get 3 times leverage, you think you're pretty levered, right? But these guys have packaged it, made it triple B, and in some cases are even making it an A by having insurance on a certain section of it, so that they are reserving about $1.20 for every $100, maybe even less, maybe 70 cents for every $100. So they can lever up 100 times on that. And they can lever up 100 times on treasuries and on corporates. So the entire aggregate, this industry is levered up, I believe. And then you have to take out, there's a lot of reinsurance and there's a lot of assets that are not legitimate. Letters of credit that took down in the beginning of the video, in the first chapter, the savings and loans companies, which is either a parental guarantee or an XOL asset. There's 4 different types of them. Those are fake. They're conditional. So when you take those out, I believe that the average of the 680 life and annuity players is levered more than Lehman. And if you want to use the insurance's favorite statistic, RBC ratio, which to the layman means how much percent of capital do you have more than what you need? If you think about that, what is the crucial assumption there? How much capital do you need? And that is what I'm talking about. It is such a low level that on a lot of these, they can lever them up 70, 100 times. And what you've done is discussed the equity that is turned into credit. So instead of being $30 from reserve, all of a sudden it is investment grade, as these guys are happy to tell you how much is investment grade.
Yeah, and they advertise one of the key things to get, a new insurance policyholders and markets comfortable is, we have 90% investment grade. But as I have done in articles on MassMutual very recently and on Athene, I've gone through the ratings and I said these ratings make no sense. In fact, MassMutual, which isn't your traditional private equity owned, like you don't think of MassMutual. They're a mutual, they're AA+, same rating as the U.S. government. They're very large, like 500 billion in assets. And I'm looking at their balance sheet, and I downloaded every single line item from their statutory filings. And I see this $2 billion to Cliffwater. Well, Cliffwater is like a BDC, but maybe worse, but I think S&P has them single A. But this sits on MassMutual's balance sheet as AA rating. And if you look at Cliffwater's balance sheet and you know that they're entirely exposed to private credit and BDCs and all of this back leverage through owning CLOs, you're like, how in the hell can any rating agency, one, understand all the risk, compiling thousands of loans, thousands of positions, and give them a single A rating. And then somehow this sits on MassMutual at a double A private letter rating. And double A means we hold no capital. And that's $2 billion out of $110 billion of assets of concern that I've documented. And there's a whole category called equity-backed ABS. What does that mean? Well, it's asset-backed securities, i.e. bonds, that's backed by equity. Now that sounds strange. Equity doesn't produce a predictable interest and coupon. How do you turn equity into a bond? Well, NAIC was concerned about that as well. So they created this new category, equity ABS, and MassMutual has a ton of it. Athene has a ton of it. And what it is, in part, taking all these private equity stakes that can't get sold because the private equity asset values are ridiculously inflated. They take all these private equity positions, they bundle them up, they find a rating agency to put a triple B rating on it, and that gets 1% capital. I'm like, this is equity. It's not an investment grade debt. As Nick said, it should have $30 of capital for $100, not $1 of capital. And NAIC, who's the regulator for insurance companies, they're not really powerful. They're not like the home loan bank who I worked for. They're a fairly weak regulator, but they understand that's ridiculous. So they put this new reporting requirement into place. So you can see the number. They haven't done anything about it. But in my view, the $10 billion of these securities that Athene owns, the $10 billion that MassMutual owns, they should have 30% capital on them. They both should, because the ratings aren't transparent. You can't see them publicly. So I only can guess from knowing what the underlying is. And all this stuff is sitting on balance sheets. And when I saw this in MassMutual, I'm like, even MassMutual, a mutual which is supposed to be safer, AA plus, government rating, and they're not private equity owned, but they do own Barings. They own Barings, but not vice versa. And Barings, in my mind, is doing a lot of the type of asset origination that Apollo is doing for Athene. So Apollo said this. They said, hey, every insurance company has an investment, a portfolio manager. We're no different. And I'm like, well, you kind of are, because private equity and insurance, there's massive conflicts of interest, as I've documented for Athene. But when I look at MassMutual, like, maybe they're right. Maybe we shouldn't just look at the private equity-owned insurers. We should look at every single insurance company, look at their relationship with their asset manager, look at the assets that they own, and not just focus on the bright line, oh, if it's private equity, I'm concerned. If it's not private equity, I can ignore it. No, all of the insurance companies should be presumed guilty unless proven otherwise. And when I talk to insurance experts, like, I can count on one hand how many of them they consider the insurance companies to be not have been playing this very risky asset game, because they're all forced to, right? They're forced to play it, because if Athene is getting the market share by writing annuities with a 5% coupon or 6% coupon, and I'm at Life and I have to compete with the financial advisors, and maybe the financial advisors are getting paid by Athene, I got to write higher annuity policies. And if I'm now writing 5% annuities, how am I going to invest in my safe corporate Microsoft bond? I now have to invest in riskier assets in order to pay that annuity. So everyone's forced to, the same way in the subprime crisis, where almost every single bank, every single lender, with a very small handful of exceptions, had to play that same subprime game. Every investment bank, every commercial bank was somehow involved in, because that's the market, that's where the money is. And I think you have to look at insurance companies as, everyone should be evaluated independent of whether they're private equity owned or not. There should be an assumption that there's risk beyond who the owner is.
So begrudgingly, some of these guys are taking more risk. Those are the B players. There are no A players. The A players are extinct. There are only B, C, D, and F players. And
you mean the insurance
right
companies?
Right. Because you can't compete. You're out of business if you're an A player. What has happened, and people that have been around long enough looking at insurance companies can tell you this distinctively, and it's written up, you can read about it too, is the demutualization. And what that precipitated the global financial crisis. So a mutual is like the Green Bay Packers, and that means that the policyholders own the business. So really, if you think about it, it's kind of a pretty clean model. It's like a co-op. They demutualize and they become public. And when you're a public company, you have to pay dividends. You have to impress the sell side analysts because you want to get paid as an executive. The PE-backed insurers are just profit centers. They are the golden childs at this point in time for the private equity firms. But Rod and I, working on MassMutual particularly, are identifying even mutual companies that are taking excess risk. The pubcos, there are plenty of bad actors. The PE-backed insurers, speaking to actuaries, speaking to chief risk officers, former chief risk officers that were like, I can't have this on my watch. You guys brought me in. I thought you were lean. I thought you guys were going to beat everyone else just by being smarter. And I'm getting in here and realizing you're actually just taking a tremendous amount more risk. So this is a $10 trillion balance sheet. This is $2 trillion of private credit, direct lending, if you want to count it that. This is bigger than the global financial crisis, where there was only $1.2 trillion of subprime lending. The total amount of liabilities today are bigger than the banking system in 2009. And in fact, comparable to the banking system today. It's 10 trillion versus 13 trillion. So while the reason why we believe that this is systemic is because of the size of it, and in fact, we haven't even gotten into the reinsurance, there's a bigger hole when shit hits the fan, because you cannot liquidate these businesses, and the assumptions are even worse, and the financial engineering has gotten even greater. So when we're talking about, and the reason why it's so important to listen to what happened during the last time is because this is not just going to affect private credit. This is going to affect every credit. And it's going to happen from the outside instead of the collateral system. The collateral system, we know how to defend and fix. I don't think the regulators or the government or the Federal Reserve or the Treasury or anyone potentially knows how to deal with a credit event like this. And I just look back to Japan. And that's where I get worried, because I'm like, I got 20 years. I just want to have a good economy, please. I want to start a family. That would be great. Instead, it's going to be no growth. And if there is any growth, it's going to come from AI, in my opinion. And it's just going to be a consistent unwind, like the savings and loan times 100.
Yeah.
What do you think?
I think you earlier you touched on something that I think you said you're the only one looking at it, and I think I have not seen it discussed or analyzed that much. You gave an example, roll up of dental practices, and I've written about that, and I've not only written about it, but I've been talking to this guy whose wife had a dental practice taken over by private equity, and they were absolutely horrible. They were driving costs down, driving them to recommend procedures that weren't needed, pushing customers who were low paying back to the end of the queue. So she ended up quitting. They kept running her business, but they used her tax ID. So she was getting taxable income to the IRS that she wasn't earning. And basically the identity theft, right? And I'm going to tell that story when they've been in long-term litigation with a private equity. It's not one of the brand names, but your comment on the roll-up of dental practices. Imagine roll-up of anesthesiologists, medical practices.
Kidney,
They've permeated so
renal care. They want recurring revenue.
Care.
So they do software, but they also do everything that every year happens in a home, or maybe once every 10 years in the case of roofing. If it's recurring revenue, you can lever it to the tits.
Yeah. And then the reversing of that, all of those roll-ups, and maybe the last time, during the Milken days or whenever the last time you want to say there was a bubble burst in private equity or CDOs, now the size is much larger, the complexity of these and the penetration into our day-to-day economy. I was on Reddit the other day and I'm in New York City, and somebody popped up, hey, why is Pure Gym shutting off the air conditioning all the time? And I thought, who owns Pure Gym? They're owned by KKR and another private equity. I said, check the owners. They're turning it off because they're saving money, right? How do we save money in the gyms we own? Well, let's turn off the air conditioning. It's a big cost. We don't get paid for it. Every single business and dental practice world. So when they start defaulting, and private equity, private credit, they don't work on low leverage. They only work on high leverage, 70% leverage in terms of the debt stack, and measured in different ways. But imagine unwinding, as Nick said, these dental roll-up practices, renal practices, anesthesiologists. They have networks of hospitals. How do you liquidate all that without destroying or damaging a large part of the broader economy? So think about this not as a financial engineer thing. think about the penetration of private credit and private equity into every single facet of your economy. There was a video today I was watching on bowling alleys, of all things, how private equity is buying up all the bowling alleys and destroying your neighborhood bowling alley. I don't know if I buy it, but it shows you how deeply penetrating. Anything where there's a cash flow, anything that's leverageable, they're going to, entice you as a small business owner. Oh, come join our network, our dental network. I have 2 nieces who are going PhDs in dentistry from UPenn. And I'm telling my sister, I said, make sure, they know what they're getting into and are aware of who they may be working for, who their boss may ultimately be, because it's no fun working as one of a cog in a wheel of a dental roll-up that ultimately reports to a private equity company that just wants to make their 2 and 20 incentive fees and pay their carried interest. So it's the unwinding of that, Nick, that I think you really hit on something important, and how that will, who's going to handle all that, right? If all of these private equity companies are not around, you're going to have vulture investors buying 50 dental practices. Who's going to be buying the critical parts of our healthcare infrastructure that's now been in private equity? It's just going to be, I think far more complex. Like selling a Yugo dealership or a cattle farm during the savings and loan day is child's play compared to unwinding, if the private equity industry themselves don't have the capacity to deal with the unwind.
There's already 36,000 companies waiting to be sold that are in year 7 of their ownership. Imagine if they have to sell those. Right now, they're continuing just holding them over 10 years in some cases. But imagine if you have to sell. And the mortgages, so if you have all of these businesses going under, what do you think residential real estate's going to do? You were talking about the average home price to the median wage in 2008. It's like 50% higher now. Even if we just go back down to global financial crisis levels, how much wealth is eliminated automatically? And then you have commercial real estate that's a disaster. And the mortgage portion is massive on these insurers' balance sheet as well.
Yeah, I'll tell you a story on one of in my post working for mainstream financial institutions. I've been an independent journalist for the past 10 years. And speaking of commercial mortgage backs, there's a product called single asset, single borrower. It's basically a AAA mortgage backed bond backed by a single property. Now, to me, unless it's the Pentagon leasing for 20 years, there's no single commercial mortgage property that can support a credit rating better than the U.S. government. None. Not only that, I identified a few years ago 12 properties, 12 AAA mortgage-backed securities where the underlying loan had already defaulted. And they were still AAA. And I call it the Dirty Dozen. The Financial Times picked up the article. TREP, which is an expert in commercial, picked up my article. So I said, how can you have 12 mortgage securities bonds where the loan is in default and still be AAA? Now, they default well after the trouble is revealed. They have cash flow problems. They go into special servicing. The fact that even after defaulting, not paying the mortgage, the rating agencies figure out a way to maintain it. It's a story about commercial mortgage backs, but it's also a story about epic failure of the rating agencies on a scale like Dodd-Frank you talked about. They did nothing for the ratings. The ratings reform is nothing. I see it as far worse than it was back then, far worse. And that Dirty Dozen story is basically emblematic. If they're going to rate AAA on single property loans that are already in default, imagine all this other stuff that's a lot easier for them to justify ratings, or a lot more complicated for people to figure out the ratings are wrong.
And to take it to the average person, if you made it this far, that's amazing. But they have lived this life outside of financial supreme expertise where they can understand what is happening in an economy. No fault to them. They might be focusing and interested in different things. But what they've noticed, and what I would say to them, is private equity's game plan is raising costs. In dental practice, it's saying you need a tooth cleaned, you have a cavity you don't have, and also raising prices and cutting costs. The biggest cost, the majority of the time that you can influence, is wages. So they are both trying to take as much money as they can from consumers. Businesses are kind of harder to mark up on typically, but consumers buy everything in the industry while laying off as many people as possible. And these businesses have no heart. They have no soul. These are not the mom and pops where you love your job and you love what you do. This is, what is the movie Megalopolis type businesses. And they will tell you that they are the best. They provide 50 million jobs, 25 million jobs. I've seen reports like this. But in reality, their utility has gone far past, hey, we're just providing financing. We're stepping in where the banks wouldn't. And it's become a grab all and catch all that my math has at least $500 billion between management fees in private credit and private equity, the bank's underwriting fees, the lawyer fees, the auditor fees, the rating fees, all of it per year is being sucked out of the average person. The average person doesn't participate in that. And I think this is a good lead into what your website is called, which is The People's Economist. Do you want to talk about that for a second?
Yeah. So after leaving Wall Street in 2011, I worked for a Bangladesh charity for 8 years and traveled to places like Liberia, Sierra Leone, South Sudan, and worked for a really wonderful organization. But I decided, I wanted to get back into my wheelhouse of my skills, but I still wanted to do something that's helping people and entrepreneurial, so I can have some control. So I created the People's Economist TPE Hub. The People's Economist Hub, TPE Hub is the website. And I created a tool of personal finance tools, everything from retirement to budget analysis to investments, mutual funds. I have a whole bunch of dashboards, equity, fixed income. There are a bunch of articles. We have a news engine, so we create daily news stories. And I'm using it personally for the past couple of years, and I critically rely on some of the tools. And it's I've now merged sort of that with my journalism hat, because I'm putting some of the tools for BDCs, CLOs, and now I've got a pension data. I'm putting that onto the website. That's probably more oriented towards investors than individuals. But, I really wanted to democratize access to financial tools, and having been frustrated by my having to create Excel spreadsheets for everything I did and not being happy with the Fidelity website or the Schwab or the Chase website, I said, I'm going to build my own. And hopefully if it's useful for me, others will find it useful. And so that's, and I coded up all of the calculators initially on my own. I learned Python. I coded up all the calculators, coded up the front end. I now have a few coders in one in Ukraine and 2 in India who do most of the coding now. It's a labor of love and pre-revenue. So at some point I might figure out how to monetize it, but you can follow me on Substack, which you can subscribe there and support the effort. So that's kind of the People's Economist.
Personal finance tools. If you're the average person, you're wondering what to do. You're probably also wondering.
Yeah.
You're also probably wondering when does this all end? But the number one thing I get asked is like, what's the best hedge? For 95% of people, you don't have an ISDA, which means you can't buy credit default swaps, nor would you know what to do with them. It is, and this is not financial advice because it's not a security, cash and saving, making sure that your income is good, making sure that you have a rainy day fund, and your website can help with that. And if you're an institutional listener, you might have to bid up to listen and get Rod's attention, and you might want to maintain a retainer now, because my view is that we don't have much time left. And I look at the software wall in 27 and 28. That goes current now to 27. You look at defaults that are already higher than 2008 levels, where they weren't that high admittedly, but like, how high do we need to go for there to be a problem? The answer is not higher at all. If you just maintain these levels of defaults, you have major problems in CLOs, which are on the insurance balance sheets, which will need to be unwind. And you're seeing today the Walter stuff. I just came out with a Substack article that I think some of my best work. I spent the vast majority of the weekend on one, just going through and figuring this out and talking about all of the
On which?
on Walter's two insurance companies. One is Clear,
Oh, okay.
one is Clear Spring, and one is Delaware. This is the Guggenheim CEO,
Yeah,
Guggenheim co-founder,
I'll
and
have to take a look at that.
yeah, take a look at that. And Rod has done great work on MassMutual. You came out a little bit before I was ready to talk about the work that I've done on MassMutual, but nobody expect Rod to take a paycheck to not talk about how he feels about this. And I agree, where this is a societal issue. And as a person that's 31 years old, it's like, I got to deal with this debt if we're going to do a bailout. And I don't even think a bailout's enough. So it was great to have you on, Rod. We'll be
Yeah, thanks for having me. I appreciate it, Nick. Great discussion. Hopefully, we'll do this again.
Yeah, we'll do it again. We'll offline and hopefully online one more time. And I appreciate you
Sure.
coming on to this first episode.
All right. Thanks, Nick. Look forward to chatting again.